as you feel my mind, or you feel my mind. We could build a dream, start up something new, and the world is on your shoulders, and you feel like falling over. Just let me in your head so I can be there for you, there for you. The night is young, won't you sing for me? Won't you sing for me? You will fall asleep.
Nick, we can't hear you. Your mic is muted.
Oh, okay. Can you hear me now?
Now we can hear you.
Oh, all right, great. Well, everybody, welcome to VC Masters. I'm glad you can hear me now. I'm here with Dr. Salman Azar, who's the head of the Azimuth Fund and a member of the Duke faculty, to give us an update on what's going on in breaking news relating to the VC world. I mean, I've seen quite a bit of changes in this area, but we'd like to hear from you what's going on in the VC world right now.
Well, things have been pretty steady. So I guess no news is good news. And what by that I mean that when we look at the index of private fund companies and companies that are relatively closer to an exit through acquisition, they are at about 3 times their value since 2019. So you can think of it just pre-COVID value. They've gained about 200%, 3 times the value. And they've been pretty steady there for the last few months, particularly after the April announcements of the tariffs, which kind of shook the market a little bit. But what has been amazing is that how quickly the private markets and the VC markets have recovered from those tariff news. Usually it would have taken years for them to recover from them, and it has just taken weeks for them to be back in action. Things are beginning to get to the point where companies are thinking about IPOs again. A lot of them paused their IPOs in April after the tariff news. And we are kind of in a wait and see mode with a number of companies such as Chime, for example, announcing the IPO and actually going IPO. I have a company, Permuto, that yesterday cleared the way for their IPO, and it's now a matter of timing. And we can get into the timing discussion later in the show.
Okay, what I've seen in the marketplace also is that it looks like the Latin American activity is down. I'm meeting with somebody from Brazil tomorrow on that, but I don't know what the story is, why it's down. Do you know? And the thing is, it looks like Europe, where I'm at, is actually up. Have you seen there's some trends globally when it comes to the VC market? We know that the United States is the world's largest economy, so it's a lot of activity. But have you seen a lot of changes in the global markets as well?
Yeah, so Latin American market did very well relative to the global markets in the recent months, whereas Europe lagged a little bit. So what we are seeing is kind of a minor adjustment, I would say, where the Latin American market had run up quite a bit. When you look at growth opportunities, Latin America still would outpace Europe in the coming years, simply because it has a lot more room to run still. But there is some people that are kind of a little bit cautious because the valuations have risen up quite significantly. I'm deeply invested in one Latin American company that is growing at about 50% year over year, and the valuations are kind of like keeping pace with that, particularly in fintech and a lot of developing nations like Brazil, Mexico, Colombia. These have grown significantly, whereas Europe has been a little bit steady, and I think we're just seeing a little bit of an adjustment and rebalancing here.
Yeah, Steve Schwartzman, who heads up the Blackstone Fund, says they're going to pump in about $500 billion into the European market because they see more opportunity, more steady growth in that particular area. But Also, something that I get hammered on all the time, but I'm not a fan of, and I don't know what your thoughts. It's called crypto. Cryptocurrencies are down, but I can't get a handle on something I can't figure out. And this is something that I've looked at. I even have some, but I can tell you, I just can't figure it out. And apparently, the market hasn't been able to figure it out either because the investors are down. So, what are your thoughts on crypto? I know this, I'm putting you on the spot, Dr. Azar, but I'm curious. What are your thoughts on crypto?
Discussing crypto is like discussing religion at times. I'm going to be attacked by a number of people, regardless of what I say here. But the way, so I'm just going to talk openly about my kind of view of crypto. Cryptocurrency is just like any other currency. The more people that believe in that currency, the more it's going to rise and more people are going to buy that particular currency. If you really think about US dollar, especially when it was de-linked with gold and stuff, it is just a currency. And the reason why it is so popular all over the world is because it is backed by the US government and people have a sense of comfort when it comes to US dollars. When the whole BRICS movement started, which is Brazil, Russia, India, China, and South Africa? I've forgotten what the S was in that, which is kind of like an alternative response to the dollar because a lot of these countries don't want to be dependent on the US dollar. That did kind of sway some of the people from investing in US dollars to kind of moving over to BRICS. And it did hurt US dollar. Cryptocurrency is similar. When you look at the blue chip cryptocurrency, such things like Bitcoin, they would always, in my opinion, be there. I mean, obviously, there can be a number of things, but the value that people ascribe to cryptocurrency really is the value that it is at. And right now, there is a high level of confidence in Bitcoin, and there is a very low level of confidence in some of the other newer cryptocurrencies that have come about. All that said, I looked at the whole crypto Web3 kind of market as more of a blockchain market that has a lot more potential than just doing cryptocurrency. For example, Permuto, which I just mentioned, is a company that is separating dividend and stock ownership. So now hedge funds can just buy stocks and pension funds can just buy dividends, which makes it a lot easier for people to invest in what they want to invest in. Historically, pension funds are stuck with the dividend portion of, let's say, Microsoft or Broadcom or Apple. But now they can just say, okay, I'm just going to buy the stock appreciation of that. And I'm going to buy that at a lower cost than what the current value of that particular share price is. So if the share price is 100, I can buy it at, let's say, 80 and just benefit from the appreciation. And then if I'm buying the dividend, I can buy it for 20 instead of 100, which is 1/5 of the price, which effectively has the effect of making your dividend 5 times as much. So that these kinds of applications, contracts, security validation, this is where I see really the crypto market going.
Okay, another market that looks like it's fast moving, and I'm not sure what your thoughts are, is the AI market, artificial intelligence. I mean, we get this all the time, and venture capital flowing in, but it looks to me also that they have a competitor, which is the old established corporations. Palantir was one, which, you know, Peter Thiel, the great chess player, kind of started that company, and I have followed it. Well, it's up like 78%. I mean, it had a tremendous increase. But are the AI startups, are they going to face a problem with the existing large technology companies like Google, even Pegasystems, which I've invested in? It's another chess player, Alan Trefler's firm, who was on the front page of Chess Life in Review. I found that interesting last month. But are these AI startups going to be hurt or helped by the existing large technology companies? And I think that's the question that everybody has on their table. Or will one AI company that we don't even know of emerge to be the big winner of the AI market? What is your thoughts on AI?
So I have many thoughts on AI, which is, again, you're asking me a lot of religious questions here today, which is going to get me into trouble with a number of audience. But again, I'm going to be authentic and I'm going to share exactly what I think about these things. or what I've analyzed about these things. So first of all, when we come to the smaller AI players and the threat that they face from bigger players, that definitely is a threat for most of the smaller players. And the reason for that is that it takes a lot of compute power, and that compute power translates into dollars as well to train these AI models, which makes it very difficult for the smaller companies to compete with the bigger companies that have a lot deeper pockets and have a lot more compute power as well available. But at the same time, the bigger companies are going to acquire some of these smaller companies, and that is going to definitely benefit these smaller companies. So the way I see this playing out is very similar to what happened during the dot-com era, where there were a number of companies that had forecasted a certain market share. Let's say 100 companies had forecasted that they are going to get 20% market share, and when you kind of add those up, it just doesn't add up to 100%. In fact, it adds up to much more than 100%. And what that resulted in is really a shakedown where a number of these companies went out of business, but they were the ones that survived did very well. So it is going to be more of what we heard as a K-shaped outcome, where a number of these companies are going to benefit tremendously from getting acquired by bigger companies. But most of them are going to go under because they simply won't be able to keep up. AI is an evolving industry, and given that everything that I just said can be totally changed tomorrow, if there is a way to gain the same level of accuracy or better accuracy in AI prediction with less compute power and lesser dollar investment. If that happens, then the smaller companies would have a significant advantage because they can pivot and move a lot faster than the bigger companies. And they can also go after some of the low-hanging fruit that the bigger companies won't care about because it won't move the needle. So, I mean, if it is not like billions of dollars of opportunity, Google, Microsoft, these kinds of companies are not going to chase after that, whereas the smaller companies can chase after the millions of dollars of opportunities. So there's a lot of money to be made in the smaller opportunities. A number of them involve setting up AI agents for traditional businesses to save them costs, etc. So there is a marketplace where the smaller companies can become a very good lifestyle business, but they're not like VC investable business that are going to become unicorns. And unicorn, by the way, is kind of a word that is used when a company reaches $1 billion in valuation.
Yeah, those unicorns are what you're really looking for, but they're also very difficult to find. Well, let's discuss private equity a little bit, because private equity has entered into my industry, purchasing a lot of life and annuity insurance companies because they're asset based. And the problem with the private equity is we don't know where they're going, but they have large amounts of assets, or at least an ability to purchase corporations, that some of them said, well, you don't even need the IPOs anymore. There's so much money in private equity today that can fund your idea that you don't need to go public or look at the public markets anymore. So again, this is throwing a curveball to you. What's your thoughts on private equity?
Oh, you have actually identified one of the key challenges that VCs are facing right now, is that a lot of companies that they had invested in 10, 12 years ago are not going public and instead getting large rounds. I'm an investor in Stripe, for example. I can't wait for Stripe to have an event, a public event, so that I can get my money back. And they keep on getting these large private equity rounds. And another thing they're doing that is very interesting is that they are also giving all these bonuses to the founders and the employees, so the employees stay with the company. So, for example, it's well known that startup salaries are not the same as big company salaries. Maybe half as much or something like that. A startup CEO may make like $180,000 a year, whereas the same person can make perhaps $500,000 a year if they were to go work for Google or something like that. and these people want to buy homes in Bay Area, and they were not qualified for mortgages of the kind of homes they want to buy. So what private equity is also doing is playing a very interesting game by giving them incentives. And I'm sure the same thing is happening in insurance industry and other industries where they're giving millions of dollars to founders and some of the early employees as an incentive to stay with the company, so that there's like an alternative path almost, that a company doesn't go public for decades, and perhaps never, and just stays private for a long, long time. And there is an advantage to the company as well, because there's a huge overhead of going public in terms of regulations, in terms of reporting, and also in terms of strategic planning. For example, one of the reasons it's not in Stripe's best interest to go public is that once you go public, you have these quarterly earnings reports and so on that are going to determine the price of your stock. Whereas if you are private, you don't have to live by that, a quarter at a time mentality. So you're absolutely right. Private equity is coming out as an alternative to public markets. And that alternative is changing the whole landscape of how things are working out right now.
Okay, another important thing when it comes to any investment, I do spend a lot of time with this particular area before I invest, is valuation. In other words, when it comes to valuing these companies, some of them are easier to value than others. And the goal, of course, at least if you're an investor, is to buy an undervalued company. So how do you go about doing valuations on these corporations, especially the closely held business owners? How do you go about doing that?
Yeah, so first of all, why is valuation important? The reason valuation is important that most of the money that you make in a deal is when you get into that deal, by how much of a discount that you get to what that company's value would be when you exit. It is easier to control the valuation when you get in, because you may be looking at 100 companies and you can choose one company out of that. But when you are selling companies and you are selling a particular company, you are tied to that. So it is very difficult for you to have alternatives of 100 buyers, for example, and kind of try to negotiate between those things. In terms of valuations, it's really tied to the private equity that you mentioned. So a number of investors who have invested in these companies want their money back, and as a result, they are willing to sell their stock or their shares at a discount to the current fair market value. And this is something that I discuss with auditors all the time, because they have a tough time these days to figure out what a fair market value of a company like SpaceX, for example, is. Is it the value that their shares are selling at in the secondary market, or is it the value that they would get if they were acquired by another company today or go IPO today? And the answers are going to be different for different companies. For SpaceX, which is a household name, the difference is not going to be that much. But let's say there is a company like Koros or Kresge, which is just below the radar of these top, decacorns that we see in the news. These companies, their fair market value may be twice as much as what their trading value is these days. And that's actually where we make most of our money, because we are able to get those valuations at of 40 to 50% of the fair market value, where the fair market value is what if they were to be acquired today or go IPO today. The closer you get to the IPO or the acquisition, the discount shrinks. So what would be a 40% discount for a company that is going to go public or get acquired expectedly in 2 years, if you are close to like 3 months away, then that discount would be much less. To give you kind of a particular example, Klarna is a company that was planning to go IPO earlier this year, and the discount to the fair market value was something like 10%. After the tariffs, they announced that they are going to delay their IPO, and that increased that discount to 15 to 20%. And now, well, actually, I can't say. There is inside information in terms of when they are going to go public. And as that is coming in, that date comes nearer and nearer, the discount is going to shrink. So one of the ways that if you, without having any information that I have or any insider would have, and by the way, this is legal information in private companies as investors because we get investor reports, you can gauge how close a company is to IPO, or not gauge, but estimate how close a company is to IPO, but by how much they are getting as a discount to the fair market value.
Okay, and another problem that we've seen in the public markets when someone goes public, especially when it comes to the founder of the company, and I've seen this happen over and over again, is that they all of a sudden, and this is one I'm looking at right now, it looks like the company went public, and then all of a sudden the owner, who I'm talking to right now, so I'm not going to name the company, was worth 10 billion because the company went public with 30 billion. But there's something called the 144 restricted stock. Once a company goes public, is generally can the founder sell, or are they going to be restricted in not being able to sell their stock right after the public offering? What are your thoughts on that?
Yeah, so that is an important consideration, and a lot of founders and employees don't realize that the stock that they have usually comes with a lot of strings. Even before a company goes public, a founder can't just get up and sell the stock. And the reason for that is that the stock is an incentive for that founder or those early employees or even regular employees to work harder in order to increase the value of the company. So taking a step back, the VC model is such that we take a smaller percentage than the founders and the employees do. So the employee pool is larger than any particular VC investor. And the reason we like it that way is that incentivizes these people to work harder to increase their net worth and also help us in the process. Now, if they turn around and sell all their stock away, and all they are left with, let's say, is $180,000 salary for a $500,000 employee, they won't have the incentive. In fact, they won't even stick around. So regardless of whether the company is private or public, there are all kinds of restrictions on founder stock in particular on when they can sell. In addition to those restrictions, there are also restrictions on the investors when they can sell. And most of these restrictions are that as an early investor, when one of my company goes public, I can't sell their stock for 6 months. So you have to be very careful about restrictions, and they're just not like one type of restriction. There are many types of restrictions. And typically these involved when and how much of stock you can sell and what you have to disclose. I have, my son works for a publicly traded company that recently went public a few years ago, and he has a certain window that he can sell the stock, and he cannot sell or buy any of the stock outside that window, even though he's not a founder, he's an early employee, because of that restriction.
Okay. The other thing that employees are offered quite often, but in some cases they don't understand, it's called stock options. A matter of fact, a lot of stocks, you can buy stock options without being an employee. Can you explain to our audience a little bit what are stock options?
So stock options are options that are given to usually early employees and sometimes advisors and sometimes other people who help the company increase in value to incentivize them for increasing the value as much as they can. So for example, if I have a consulting contract with a startup, instead of getting $1,000 an hour or something, I would generally have some stock options that would be vested over a certain period of time. And those stock options would give me the right, but not the obligation to buy their stock for very, very cheap prices. And that by cheap prices, I mean like pennies, or sometimes even a penny, or sometimes even I've seen fractions of pennies. And effectively what that means is that you're giving almost free stock to these people in order to get their help, because cash is something that is very tight. And also you just don't want to give cash away and this person doesn't perform. This person now has the skin in the game. I would work a lot harder to increase the value of a company where I benefit from the stock options, as opposed to value of a company that is $1,000 more, that I'm just getting $1,000 an hour for.
Good. Yeah, my personal opinion is a lot of the people employees if you give them stock options, it will not make a difference in their performance. But that's just been my experience. May not be true everywhere, but it does seem to be true, at least from what I've seen.
Yeah, so it solves another problem for startups as well, right? Smaller companies, as they're, especially if they're growing, they use their cash very wisely because cash is really tight, and even the cash they're getting, they're actually reinvesting into their growth. So they don't have as much free cash flow as a larger company would. So that's why you would also see stock options that benefit the organization just from simply saving cash.
Yeah. And some of the consultants I work have been discussing about building a moat for your company. And they especially talked about NVIDIA being a corporation that has built a moat around their company. How does a company go about building a moat, and what is a moat that you can do around your company?
So there are a number of ways that you can build a moat around the company. So we're building a moat kind of like, if you have the visual, you have this castle or a fort, and around this fort, you have this water kind of thing or a big trench that makes it harder for any enemies to come into your fort or into your castle. So that's the idea of a moat. So there are many ways to build a moat. One way is that you can just be first to market and just capture people's accounts and so on. So Facebook, for example, doesn't really have that much, in terms of patents. Well, it does have a lot of patents, but its patents are not to keep the users. Its moat, its biggest moat, is that it has this captive audience that is going to just be there. So I for example, if you have a restaurant in a mall, people are not going to go, when they go shopping, they're going to go to that restaurant. They're not going to go to another restaurant. The subway in the local mall is a lot more expensive than the subway that is outside the mall, because there's a moat around it that people who are there for shopping already are going to eat there. But there is also another type of moat, which is the intellectual property moat. And in technology, there are two main there are several ways, but there are two main ways that I'm going to talk about. One is trade secrets. Trade secrets is where you do not publish what exactly you're doing or have done, so that it is very hard for people to duplicate that. And the other is patents, and the patents also come with a number of different varieties and stuff. Patents can be blocking rights, which means that the other person cannot do exactly what they're doing. They can do something different. They can put a twist in it. And those patents sometimes have an expiration date. So the most common patent that we are all aware of, or should be aware of, is drugs. So when an initial drug is launched, it is patented, and only one manufacturer can manufacture it, unless, of course, they license it to somebody else. But only they have the right to authorize manufacturing and selling that particular drug. And after a certain number of years, let's say 15 years, when that patent expires, then you have generics that are available for that particular drug. And that pushes the price down. So the patent acts as a blocking right, which actually puts a moat around things. There are also foundational patents, which most people are not aware of, and those are much, much more valuable than the blocking patents. Foundational patents are things that define that particular space. So, for example, I have a company invested in a company called Chorus, and it's, by the way, my favorite company these days. And they have these foundational patents on how human beings interact with light. And they have now technology that can take your video screen or phone screen, block out all the blue, and your eye would not be able to tell the difference whether blue is blocked or not. So unlike the current technology that we see in our phones, where you turn on the night mode and the screen discolors and turns this weird shade of red, and the image quality goes away, Chorus's patents allow it to have a moat around it by being able to offer a screen to all viewers that looks like a regular screen, but it has blue blocked at night and blue increased in daytime, so that you can increase your focus.
Okay, and then the last question, but I don't know if you've run into this, but we've seen this. It's called the international investor. In other words, it seems to me there's a lot of capital that's being raised basically in Dubai and other places around the world. Are we going to start seeing more international investors, and actually funds that come from their government funds. Are we going to see more and more of that play in the market space, international investing and funds from certain governments?
Definitely. So, if you're listening to this show and you are an international person, we are actively looking for partners who can help us raise internationally and be compliant with the local laws and stuff, because the only reason we are not going there ourselves is because there are so many different countries and we can't just keep up with the law. So we are looking for partners that would help and collaborate with us and share basically the reward as well. But that's a huge area where a number of people are now coming into private markets. It used to be international investors only used to invest in the public US markets. And now that whole game has changed and they're looking into private markets, VC, PE. In fact, more money is coming internationally into the US private markets than from within the country.
And I think that trend is going to continue, but unfortunately, our trend is that we're past the half hour. So I want to thank Dr. Salman Azar, who's the general partner of the Azimuth Fund, also a member of the Duke faculty, and our listeners in the United States and around the world. We'll see you next week on VC Masters. Take care. Bye-bye.
Thank you.
I go anywhere with you, 'cause you fill my mind, or you fill my mind. We could build a dream, start up something new, and the world is on your shoulders, and you feel like falling over. Just let me in your head so I can be there for you, there for you.